Hello and welcome to AptCast, a series of pod and webcasts for leaders in finance where we take a look at current issues facing finance and accounting teams. Today, Aptitude Software Senior Solution Consultant and insurance expert Brian Heale will be speaking about one of the key IFRS 17 challenges that finance teams face. This is the first webcast of a 5-part series, with each one addressing a particular IFRS 17 accounting challenge. Today, Brian is talking about intercompany reinsurance arrangements. Brian Heale has over 40 years' experience in the insurance industry and has spent the last 6 years working on Solvency II and IFRS 17 implementations. So, over to you, Brian.
Thank you very much, Amanda. Many large and specialist insurers, particularly in the P&C world, make extensive use of intercompany reinsurance arrangements. This presents accounting challenges in the sense that one entity within the group will cede the risk and the other assume that risk. Thus, within the group, one entity will measure the arrangement on a ceded basis and the other party on an assumed basis. This gives the rise for special considerations in terms of local regulators, capital, tax, rating agencies, and of course IFRS 17. Firstly, let's start by defining what we mean by an intercompany reinsurance arrangement. This occurs when a reinsurance arrangement, instead of being ceded to an entity external to the group, is ceded to another entity within the same insurance group. The assuming entity thus acts as a reinsurer who, for a premium, agrees to indemnify the other party, the ceding company, against all or part of the losses that the latter may sustain in relation to the underlying direct policies. This is effectively similar to external reinsurance, but the reinsurance is an internal entity. In addition to this traditional reinsurance arrangement, there are two other types of internal reinsurance vehicles: intercompany pooling and special purpose vehicles, or SPVs for short. Let's briefly look at each of these. Intercompany pooling relates to business that is pooled among entities within a group, all of whom are party to the pooling arrangement. In this arrangement, each participant receives a fixed and predetermined share of all the business written by the pool. Intercompany pooling arrangements typically involve the establishment of a conventional quota share reinsurance agreement under which all the pool business is ceded to a lead entity within the group and then retroceded back to the pool participants in accordance with their stipulated shares. A special purpose vehicle is a subsidiary created by the parent insurer to isolate financial risk. In terms of insurance, the main use of an SPV is to assume risk from other entities in the group through reinsurance contracts or similar arrangements. In terms of IFRS 17, the accounting requirements are broadly similar. The measurements of reinsurance under IFRS 17, and indeed Solvency II, necessitate the maintenance of separate ledger entries to account for the intercompany transactions, which will increase as a result of the differences in accounting treatment between the ceding and assuming reinsurance entities within the group. Intercompany transactions, balances, gains and losses on transactions between the two entities must also be eliminated. A simple example will help illustrate this. In this scenario, Insurer C owns two subsidiary insurers, A and B. There are intercompany balances between A and B. A has reinsured liabilities with B under an internal retrocession arrangement. A measures the ceded reinsurance arrangement as a value of plus 14, whilst B measures the assumed reinsurance value as minus 16. As you can see, in this case, the intercompany balances do not add up to 0. There is a mismatch of minus 2. This simple example negates the fact that there will be a cost in one income statement and an income in the other, thus causing a grossing up effect in the group accounts, if not properly managed. Consequently, there will need to be a review of materiality an investigation and reconciliation exercise. The valuation mismatches need to be visible, typically extracted from a granular subledger, to enable management decisions. For example, how to handle and report the mismatches and why different valuation models have been utilised. These mismatches are considered in more detail below. When business is ceded with an insurance group resulting from intercompany reinsurance arrangements, then those arrangements may need to be consolidated up to group. Simplistically speaking, all ICT balances and transactions need to be removed from the group accounts. There are effectively two types of mismatch. Let's now consider unavoidable intercompany mismatches that result from different measurement requirements applying to the reinsurance business from an assumed and ceded perspective. And an example would be 1. Mismatches in initial recognition of the reinsurance arrangements. For example, retrospective insurance is recognised up front, but gains on reinsurance deferred, although the recent IASB deliberations are likely to change this. Then there are mismatches in future cash flows, for example, with respect to contract boundaries and counterparty risk. Both parties may estimate the cash flows with different timings, different discount rates, different risk adjustments, and so on. Then there is mismatches in the measurement of the contractual service margin, both at initial recognition and subsequent reporting. For example, if the variable fee approach is applied to the underlying direct contracts, the reinsurance outward is a net gain or net loss. However, the assumed direct contracts would have a CSM. And finally, there are mismatches due to entities being domiciled in different countries with potentially different accounting standards. And of course, there could well be reinsurance treaties that cover risks written in multiple currencies. And then there are avoidable mismatches, which can be managed by accounting choices, and examples of those would be 1. The application of different optional measurement approaches, e.g. the application of the GMM by the assumer and the PA approach by the cedant, or 2. Different presentation of changes resulting from variations in discount rates if the OCI option is exercised in relation to the underlying direct contracts but not the reinsurance treaty. It's unlikely that an insurer will be able to eliminate all the mismatches without major changes to their business models and or reinsurance structures, but there may be opportunities to significantly reduce misalignments. The Aptitude IFRS 17 solution is designed to handle complex entity and currency structures, as well as the varying types of reinsurance arrangements. For instance, intercompany reinsurance arrangements can be tagged and processed as separate portfolios. Consolidation and elimination up through the group hierarchies is fully supported by the accounting engine subledger structures. Custom consolidation and elimination routines can be figured and executed in the accounting engine and subledger based on rules defined by an insurer. And finally, dealing with multiple currency considerations and exposures is a major complexity which can also be handled in the subledger. To conclude then, there is still a significant uncertainty surrounding IFRS 17 in relation to the measurement of reinsurance treaties and the mismatches to the underlying direct contracts. Nonetheless, insurers may well see changes in the way they use reinsurance and how it impacts on profitability and the balance sheet. One possible consideration for insurers here is to discuss with their reinsurers, both internal and external, the prospect of redesigning any arrangements held. The result might be a more optimal IFRS 17 arrangement, facilitated through small changes in clauses without materially affecting the substance of the arrangement. Alternatively, an addendum could be added rather than rewriting the whole arrangement. Insurers may also look to utilising alternative risk mitigation strategies such as co-insurance, hedging financial risk through derivatives and banking products, or indeed consider selling run-off assets to entities located in Bermuda or elsewhere, which utilise US GAAP for reporting rather than IFRS 17. It will be interesting to see how the measurement of reinsurance under IFRS 17 changes an insurer's business model.
Excellent, thank you, Brian. I look forward to the next 4 webcast episodes looking at other IFRS 17 accounting challenges and further developments in this space. Thank you to everyone listening to AptCast, a Leaders in Finance webcast series, and stay tuned for the next episode.